In 2018, President Trump imposed a 10% tariff on all imports from China, shaking up the global economy. At the time, few realized the true impact this decision would have. The U.S. trade deficit with China had already hit $419 billion, and the tariffs were just the start of a complex economic war. But did you know that these tariffs led to massive shifts in global supply chains? U.S. farmers, for instance, saw a 50% drop in soybean exports to China, while tech giants like Apple scrambled to adjust prices. What's more shocking is that some companies actually thrived during this period, while others crumbled. The key to understanding this mess? Value investing. In this video, we'll break down how tariffs change the way investors look at the market, and how you can use these shifts to your advantage. We'll dive into smart strategies that uncover hidden opportunities, even in times of economic turmoil. Stick around, because by the end of this video, you'll know exactly how to spot these undervalued gems that others are missing. Chapter 1. The Tariff Avalanche. Understanding the basics of the 10% tax. In 2018, President Donald Trump imposed a 10% tariff on all imports from China, sparking heated debates on its economic impact. A tariff is essentially a tax placed on imported goods, making them more expensive for consumers and businesses. This move aimed to reduce the trade imbalance between the US and China, which stood at a staggering $419 billion in 2018. For many, this decision was seen as a way to boost American manufacturing and create jobs at home. However, the impact wasn't just felt in factories. The tariffs affected businesses across the board, from tech companies to everyday consumer goods. For example, Apple admitted that it might need to raise the prices of its products in response to the tariffs, passing the added costs to customers. This created uncertainty in the market, leading investors to ask, which companies will benefit, and which will suffer? Value investors, those who seek undervalued stocks with long-term growth potential, found themselves facing new challenges. The 10% tax on imports could harm companies that rely heavily on overseas manufacturing or materials. Yet, the tariffs also created opportunities for those who knew where to look. As industries reevaluated their supply chains, some companies stood to gain by adjusting quicker than others. Chapter 2. Price tags and portfolio moves. How tariffs reshape stock valuations. When tariffs are introduced, markets often react quickly, and sometimes irrationally. Stock prices can fluctuate based on the fear of increased costs or the possibility of retaliatory tariffs from foreign countries. But here's the twist. When investors panic, prices can drop to levels that make stocks of fundamentally strong companies undervalued. This is where the savvy value investor steps in. In fact, research shows that the market often overreacts to tariff news. According to a 2019 study by the National Bureau of Economic Research, the U.S. stock market experienced sharp declines right after tariff announcements, but those declines were often short-lived. The key takeaway for value investors is to recognize when the market overreacts and search for opportunities in these mispriced stocks. Take Ford, for example. When the tariffs were first announced, shares of Ford fell sharply as investors feared higher production costs. However, Ford had already been shifting some of its manufacturing back to the U.S., and the company was well positioned to handle the tariff increases. For value investors, this created a perfect buying opportunity. With a solid balance sheet and strong market presence, Ford was undervalued compared to its long-term growth potential. Other industries, such as agriculture, were hit hard by retaliatory tariffs from China. U.S. farmers saw their exports, especially soybeans, dramatically decrease. But for value investors, this disruption also led to some interesting opportunities. Companies like John Deere, a leader in agricultural machinery, could thrive as demand for farming equipment increased, even if the overall agricultural market struggled. Savvy investors recognized that long-term, certain stocks in these industries were priced too low based on short-term challenges. If you're enjoying this content, don't forget to subscribe for more insights on how to make smarter investment decisions and navigate market disruptions like tariffs. Chapter 3. The Hidden Hand. Tariffs' unseen impact on supply chains and consumer behavior. One of the most important factors in understanding tariffs is their effect on global supply chains. When a tariff is imposed, companies that rely on imports for their raw materials or finished goods may see their costs increase. Take, for instance, the steel industry. The Trump tariffs raised the price of imported steel by 25%, putting pressure on U.S. manufacturers that depended on it. However, some companies were able to adapt. U.S.-based manufacturers, like Nucor, which produces its own steel, saw a rise in demand. As a result, Nucor's stock price surged, creating a profitable investment opportunity for those who paid attention. The key to value investing in the face of tariffs is to identify companies that are insulated from tariff costs or that can pass those costs on to consumers without losing market share. Another important factor is consumer behavior. When tariffs drive up the price of imported goods, consumers tend to change their buying habits. In some cases, they'll choose cheaper alternatives made domestically. In other cases, they might simply cut back on spending. This change in behavior can affect companies' bottom lines. For example, if consumers stop buying expensive imported electronics, companies that produce similar products domestically may see an uptick in sales. For value investors, understanding these shifts in behavior is crucial. Companies that can adapt to changing consumer preferences or that have a diversified supply chain are more likely to survive and even thrive in a tariff-heavy environment. On the flip side, companies overly dependent on foreign imports could face longer-term struggles, especially if they fail to adjust to the new pricing reality. If you're enjoying this breakdown, hit the subscribe button to stay updated with more expert insights on investing during times of economic change. Chapter 4. The Smarter Investor. Capitalizing on market inefficiencies from tariffs. Tariffs can create market inefficiencies. This means the price of stocks might not accurately reflect their true value. When investors panic about tariffs, they sometimes sell stocks based on fear, not facts. This is where value investors can seize the opportunity. Take the example of the U.S. tech sector during the tariff period. Many tech companies, like Intel and Qualcomm, saw their stock prices drop due to the uncertainty of trade relations. But a closer look revealed that these companies were much less exposed to tariffs than investors thought. Intel, for instance, produces most of its chips domestically and could absorb tariff costs better than competitors with a heavy reliance on overseas manufacturing. Data shows that tariffs disproportionately impacted companies relying on Chinese imports, but many others remained relatively unaffected. According to a study by the American Chamber of Commerce in China, 60% of U.S. companies in China were not significantly impacted by tariffs. For a value investor, recognizing which companies were more insulated from tariffs allowed them to find hidden gems that the market had undervalued. Warren Buffett famously said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." In times of tariff-induced volatility, the key is to look beyond short-term price movements and focus on long-term value. Companies with strong fundamentals, a competitive edge, and the ability to adapt to tariff changes will continue to grow, even when the market temporarily undervalues them. Chapter 5. Domestic over global. The power shift in local markets amid tariffs. As tariffs made it more expensive to import goods, many companies looked inward and began shifting their focus to domestic production. This trend signaled a shift from globalism to a more localized market structure. For value investors, this shift was a signal to look at companies that could benefit from a focus on domestic production. For instance, companies like Whirlpool and GE Appliances, which manufacture many of their products in the U.S., were poised to benefit. In 2019, Whirlpool's stock jumped by over 20% as it announced new investments in U.S. manufacturing. The company's focus on local production helped it avoid the tariff pain that many competitors faced. Additionally, industries such as steel and aluminum production saw a resurgence. With tariffs on imported steel, U.S. producers like Nucor saw higher demand. According to the U.S. Census Bureau, the U.S. steel industry's output grew by 10% in 2018, even as imports dropped. The key for value investors was to identify companies that would thrive in this shifting landscape. Those that relied heavily on foreign supply chains were more vulnerable to tariff disruptions, while companies focusing on local manufacturing stood to gain. By investing in these domestic-focused companies, value investors could align their portfolios with the changing economic environment. Chapter 6. The Long-Term View. Trump tariffs and the evolution of value investing. Tariffs are a short-term disruption, but their effects can have long-term implications for value investing. While the market might react quickly to tariff news, the real opportunity lies in understanding the broader economic shifts that follow. The question is, How do tariffs affect long-term growth prospects? Take, for example, the shift in global supply chains. While tariffs initially hurt companies that relied on cheap imports, the long-term effect was a movement toward reshoring production back to the US. This shift benefits companies that are early adopters of new manufacturing techniques, automation, and local sourcing. According to a study by the Boston Consulting Group, reshoring efforts in the US were on the rise, with companies moving some production back from overseas to avoid tariffs. These companies, such as Caterpillar and General Motors, stood to gain from reduced tariffs and a more efficient domestic supply chain. Value investors who recognized this trend early were able to identify companies poised for growth in the coming years. Investors also began to recognize that tariffs could lead to changes in consumer behavior. As prices for imported goods rose, consumers might shift to domestic alternatives. For example, US car manufacturers, who had long been at a disadvantage to cheaper imports, saw an opportunity to capture more of the market. Tesla, for instance, benefited from the push to buy American-made cars, with its stock price doubling between 2018 and 2020. One of the best-known quotes in value investing comes from Benjamin Graham, who said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This perfectly describes the value investing strategy during times of tariff uncertainty. The pessimism following tariff news creates opportunities to buy into companies that will thrive in the long run. By focusing on businesses with strong fundamentals, value investors can look past short-term tariff disruptions and capitalize on long-term growth. Ultimately, the tariffs under the Trump administration created a new set of challenges, but they also provided a new landscape for value investors. Understanding how tariffs impact global trade, supply chains, and consumer behavior is key. The value investor who can sift through short-term market noise and focus on long-term trends will come out ahead. By recognizing market inefficiencies, focusing on domestic-focused companies, and maintaining a long-term perspective, investors can position themselves to take advantage of the evolving landscape. Even in the face of tariffs, opportunity exists for those who know where to look. Don't forget to subscribe for more valuable investing tips that can help you build a strong, future-proof portfolio.